Okay, so let's get right into it. You're seeing the headlines everywhere, right? Mortgage rates are starting to dip. And for a lot of people, that feels like a green light, the signal to finally jump into the housing market. But what if that good news is actually a smokescreen for a much bigger risk? We're about to peel back the layers and show you a very different story, one that suggests a housing winter could be on the horizon, and why right now might just be a trap. This right here is the big idea we're digging into today. You hear this term false bottom. What does it mean? It's a temporary dip that tricks everyone into thinking the worst is over, but it's really just a pause before an even steeper drop. And when we're talking about the biggest purchase you'll ever make, trying to catch that falling knife, well, that can be a financially devastating mistake. So, what's the game plan? Here's how we're going to break it all down. First, we'll expose why that false bottom is so incredibly tempting. Then, we're going to challenge a belief you've probably held your entire life. Is your house really an asset? After that, we'll give you the exact tools the pros use, uncover a nasty negative carry trap that so many fall into, and look ahead to a potential supply shock coming in 2026. And you'll want to stick around because we're going to end with a whole new playbook for this new world of real estate. All right, let's dive into part one. That idea that falling rates are an automatic buy signal, it's practically ingrained in our DNA. But history gives us a pretty stark warning, you know? These moments of seemingly good news often act like a siren song, luring people into the market right before things take a serious turn for the worse. And here it is. This is the number one mistake most buyers make. Their entire decision-making process boils down to one simple question: can I afford the monthly payment? So when rates dip and that monthly number looks a little better, they jump. But focusing only on that payment, it's a classic trap. It completely ignores the real value of the property, the true cost of owning it, and all the financial risk hiding just below the surface. And look, this isn't just a theory. We have seen this exact movie play out before. Just like back to the run-up to 2008. The Fed slashed rates, flooding the market with cheap money. Lenders got real creative with these teaser rates and adjustable rate mortgages, right? They offered these incredibly low initial payments. And millions of buyers, looking only at that first payment, bought houses they could never actually afford. Of course, when those rates reset, bam, payments skyrocketed, defaults exploded, and the entire house of cards came tumbling down. It's a powerful lesson in how seductive a low monthly payment can be. This brings us to probably the most important foundational concept we're going to talk about today. It's an idea from Robert Kiyosaki that completely flips conventional wisdom on its head. If you want to understand the market like a pro, you first have to unlearn the biggest myth out there: the idea that the house you live in is your greatest asset. Okay, let's just pause here and reset our definitions, because this is everything. For a professional investor, an asset isn't about what it might be worth someday. It's about what it does for you right now. An asset puts money into your pocket, period. Think of a rental property that, after you pay all the bills, leaves you with cash at the end of the month. That's an asset. And the flip side is just as simple. A liability is anything that consistently takes money out of your pocket. It's a constant drain on your cash flow. Your car, your credit card debt, those are obvious liabilities. But by this definition, your primary home is the ultimate liability. Every single month, it takes money out of your pocket for the mortgage, taxes, insurance, repairs, you name it. This chart just lays it out perfectly. It's a night and day difference in thinking. The average person, the retail view, says, my house is my asset because someday I'll sell it for more money. That's not investing. That's pure speculation. You're just hoping. The investor, though, they ignore the hope. They look at the hard numbers today. They see the endless expenses, mortgage, taxes, insurance, that leaky roof, and they see a machine designed to consume your cash, not create it. Okay, so if the pros aren't just speculating and hoping for the best, how do they actually figure out if a property is a good deal? Well, they use a simple but really powerful toolkit to cut through the noise and get to the financial truth. And it all starts with two numbers that are way more important than the sticker price. These are the two numbers that separate the amateurs from the pros. First up is net operating income, or NOI. Think of it as the property's pure raw profit before you even think about a mortgage. Let's say a building brings in 20 grand a year in rent. After you pay for taxes, insurance, and maintenance, say 8 grand, your NOI is $12,000. That's simple. The second tool is the cap rate. You just take that NOI, our 12 grand, and you divide it by the price of the property. What you get is a percentage. And that percentage is the real, unleveraged return on the investment. It's the true measure of how well that asset performs as a business. And that's why the cap rate is so crucial. It gives you the pure, unfiltered financial performance of the property itself. It lets you look at a building in Ohio and a building in Arizona and compare them apples to apples. It answers one simple question: which one is the better business? And it does that completely separately from whatever kind of loan you might put on it. All right, so now that we have these tools, let's see what happens when we apply them to the current market. This is where it gets really interesting because when you do, you uncover this incredibly dangerous situation that millions of home buyers are walking right into. It's called the negative carry trap. So let's put some real numbers to this. Based on projections, a typical investment property today might have a cap rate of around 5.6%. That's the return the asset itself is generating. So if you bought $1 million property, it would be spitting out about $56,000 a year in pure profit, or NOI. Just burn that number into your brain, 5.6%. Now, let's bring the bank into the picture. You get a mortgage, and in today's world, that interest rate might be somewhere around 6.8%. That's your cost of borrowing money. Now, you see the problem, don't you? The cost to borrow the money is actually higher than the return the asset is giving you. This is the classic definition of what Kiyosaki calls negative leverage. You're borrowing money at almost 7% to buy something that's only earning you about 5.5%. You're literally paying the bank more than the investment is paying you. It's a guaranteed losing formula from the moment you sign the papers. And that leads us to the brutal, simple truth of negative carry. When your cost of capital, your mortgage rate, is higher than your cap rate, you are locking in a monthly loss. The money coming in from the property isn't enough to cover the bills and the loan payment. So what happens? The owner has to dip into their own savings month after month just to keep this so-called asset afloat, all while just hoping and praying that the market price goes up enough to bail them out someday. And about that hope for future appreciation, well, it might be on a direct collision course with reality. Because when you zoom out from just one property to the market as a whole, you can see two huge, unseen forces that are set to collide and could completely reshape supply and demand over the next couple of years. Now, this slide tells a story, almost like a 3-act play. Act 1 is happening right now. We call it the Great Lock-in Effect. You have millions of homeowners sitting on these crazy low 2 or 3% mortgages. They have absolutely no reason to sell their home and take on a new 7% mortgage, so they're staying put. This is choking off housing supply and keeping prices artificially high. But Act 2 is coming fast. Between 2025 and 2026, this $1.8 trillion wall of maturity is going to hit. This is all commercial real estate debt that has to be refinanced at today's much higher rates. A lot of operators won't be able to make the math work, which could trigger a wave of forced sales. And that leads to Act 3, a potential reversal where all these properties suddenly flood the market, finally bringing on a wave of new supply and putting real downward pressure on prices. So, with all that going on, a tricky market, negative carry, a potential supply shock, how on earth are you supposed to navigate all this? The answer is, you have to fundamentally change your approach. You have to stop thinking like a speculator and start acting like an analyst. It is time for a brand new playbook. Here it is. This 4-step framework is basically your new shield. Number 1, stop speculating. Forget about what you hope the price will be in 5 years. Focus only on today's numbers. 2, analyze the cash flow. Do the work. Calculate the real NOI and cap rate. 3, compare your return to your cost. Is the cap rate higher than the mortgage rate? If the answer is no, it's a bad deal. Walk away. And 4, maybe the most important step, stress test it. What happens if a tenant leaves? What if taxes go up? What if the water heater breaks? If a small surprise turns your deal from a winner into a loser, the deal was too fragile to begin with. And that's really the big takeaway here. This whole process isn't about trying to be a genius who can perfectly time the bottom of the market. Nobody can do that. It's about finding a deal so solid with such strong fundamentals that it makes financial sense whether the market is going up, down, or sideways. A great deal protects you from a bad market. So we'll leave you with this one last thought to chew on. When you really get down to it, professional real estate is a game of cold, hard math. It's about spreadsheets and calculators. But for most people, buying a home is almost entirely emotional. It's the fear of missing out, the dream of ownership, the excitement of seeing rates drop a tiny bit. So in a market that's ultimately governed by numbers, maybe the biggest risk of all isn't the interest rate. It's making the biggest financial decision of your life based on feelings instead of facts.